Warren Buffett sits in his modest office in Omaha, Nebraska, the same place he's worked for decades, and when people approach him with questions about money, he always brings the conversation back to fundamentals. The Oracle of Omaha, as he's known worldwide, has built one of the greatest fortunes in history not through complex strategies or secret formulas, but through principles so simple that most people overlook them entirely. At 94 years old, Buffett has never truly stepped away from the game. He doesn't believe in traditional retirement, and watching him work reveals why thousands of investors hang on his every word. Throughout his career, he's observed countless individuals chase wealth, some finding it, others losing everything they had. What separates the winners from the losers, according to Buffett's philosophy, isn't intelligence or luck. It's understanding a fundamental truth about money that most people get backwards. When aspiring investors ask Buffett how much they need to achieve financial freedom, he redirects their thinking immediately. The question isn't about reaching some magical number. Financial independence means having enough resources that work becomes optional, not mandatory. That distinction changes everything about how someone approaches building wealth over a decade or any time frame. The calculation starts with spending, not earnings. Buffett has watched too many high-income professionals remain trapped because their expenses match their salaries. Someone earning $200,000 annually but spending $190,000 lives with less freedom than someone making $60,000 and spending $30,000. The math determines destiny, and Buffett's approach to this math reveals decades of wisdom. His preferred framework relies on what financial planners call the withdrawal rate principle. The concept suggests that a properly invested portfolio can sustainably provide 4% of its value annually without depleting over time. This means someone needing $40,000 yearly requires a $1 million portfolio. Someone needing $80,000 needs $2 million. The portfolio size flows directly from lifestyle costs, not arbitrary goals about becoming a millionaire. This 4% guideline isn't perfect, and Buffett knows its limitations better than anyone. The calculation assumes roughly 7% returns after inflation, a balanced mix of stocks and bonds, and approximately 30 years of withdrawals. For someone retiring at the traditional age of 65, these assumptions generally hold. For someone leaving the workforce at 50 or 40, more conservative estimates become necessary. Early retirement demands that money last longer, so withdrawal rates might need to drop to 3.5% or even 3%. Running through a practical example reveals how these numbers interact. Consider someone wanting to maintain a $50,000 annual lifestyle in retirement. Using the 4% rule, they'd need $1.25 million because 4% of that sum equals their annual needs. That becomes the target. Now the challenge shifts to reaching that target within 10 years, which depends entirely on two factors: current savings and expected investment returns. Buffett can't predict markets, and he's the first to admit that nobody can. However, historical data provides reasonable expectations. The stock market has delivered approximately 10% annual returns over the past century. Some years bring 30% gains, other years produce 20% losses, but the average hovers around 10%. Using this figure for planning purposes gives a realistic baseline, assuming full stock exposure and normal market conditions over the coming decade. The scenarios vary dramatically based on starting positions. Someone beginning from zero faces the steepest climb. Reaching $1.25 million in 10 years with 10% returns requires investing roughly $6,500 monthly. That's $78,000 annually, a figure beyond reach for most people unless they earn substantial incomes and live far below their means. The mathematics aren't forgiving at this level. Someone starting with $100,000 already saved faces easier numbers. That existing capital will grow on its own, meaning new investments only need to cover the gap. With 10% returns, they'd need to invest approximately $5,000 monthly or $60,000 annually. Still challenging, but more achievable for someone serious about the goal. The numbers improve dramatically with a stronger foundation. Someone possessing $250,000 in savings has momentum working in their favor. At 10% growth, that $250,000 becomes roughly $650,000 over 10 years without adding another dollar. They only need to save an additional $600,000 through monthly investments, which requires about $3,000 monthly or $36,000 annually. This represents a realistic target for many committed savers. This illustrates the power of compound interest and early action. Money already saved works continuously, growing and multiplying without additional effort. Someone who starts building wealth at 30 has a massive advantage over someone who waits until 40. The head start compounds over time, making later goals either easier to achieve or allowing for more ambitious targets. Buffett always emphasizes the assumptions underlying any financial projection. 10% returns represent an optimistic scenario. Markets don't move in straight lines. They surge and crash, sometimes violently. Someone retiring immediately after a major market crash faces serious danger because they're withdrawing from a depleted portfolio that might not recover quickly enough. This sequence of returns risk represents one of the most significant threats to early retirement plans. Managing this risk requires building safety margins into every calculation. Buffett would recommend planning for lower returns, perhaps 7 or 8% instead of 10. Alternatively, save more than projections suggest is necessary, creating a cushion for when things go wrong. The third option involves maintaining flexibility. If markets crash right at the planned retirement date, working another year or two protects the entire strategy. Buffett values flexibility over rigid adherence to plans that ignore market reality. The spending side of the equation offers equally important opportunities. Reducing expenses creates a double benefit that Buffett has explained countless times. Someone who can live on $30,000 annually instead of $50,000 only needs $750,000 instead of $1.25 million. That's $500,000 less to accumulate, a massive difference in required savings. Cutting lifestyle costs from $50,000 to $20,000 drops the target to just $500,000. Most people resist this idea initially. They believe they can't possibly live on less than their current spending. But Buffett points to countless examples of individuals who've reduced expenses dramatically once they committed to financial independence. Moving to lower-cost regions, eliminating unnecessary purchases, and adopting simpler lifestyles make things possible that seemed impossible before. Two paths lead to early retirement, and Buffett sees people focus overwhelmingly on the harder one. The first path involves earning more and saving more. The second involves spending less and needing less. Most people fixate on increasing income, but cutting expenses often proves easier and more powerful. Reducing spending by 20% means needing 20% less for retirement while simultaneously having 20% more available to save. The double benefit accelerates progress dramatically. Consider an aggressive example that Buffett might analyze. A 35-year-old earning $80,000 annually decides they want to retire at 45. They cut spending to $30,000 yearly. Not easy, but definitely possible with motivation. This allows them to save $50,000 annually, representing a 62% savings rate. Living on $30,000 means they need $750,000 to retire using the 4% rule. Can they accumulate $750,000 in 10 years? With $50,000 in annual savings and 10% returns, they'd reach approximately $800,000 after 10 years. The math works. They'd hit their target and could retire at 45. Would Buffett recommend this approach? Perhaps, if the person truly understands the risks and remains committed. But it's aggressive, assuming high returns, minimal spending, no emergencies, and zero margin for error. A market crash at the wrong moment could derail everything. Social Security often gets overlooked in retirement calculations, which Buffett considers a mistake. The average Social Security benefit provides about $1,800 monthly or $21,000 annually. Someone retiring before 62 won't receive these benefits immediately, but once they reach eligibility age, that income stream reduces portfolio withdrawal needs. Instead of pulling $50,000 yearly from savings, they might only need $29,000, which means requiring a smaller portfolio, perhaps $750,000 instead of $1.25 million. Buffett thinks about retirement planning in layers. Social Security forms the foundation, providing guaranteed lifetime income. The portfolio represents the second layer, built through years of disciplined saving and investing. Flexibility constitutes the third layer, the ability to adjust plans based on reality. If markets crash right at retirement, Working another year or two preserves the strategy. That flexibility provides security, enabling early retirement without excessive risk. The practical question of where to invest monthly savings determines success or failure. Saving money isn't enough. That money must work hard, invested properly to generate returns. Investment location determines performance, and performance determines whether someone hits their targets. Buffett has always favored stocks over every other asset class for long-term wealth building. Over extended periods, equities outperform bonds, cash, real estate, and everything else. The stock market's 10% historical annual return comes with volatility, but for someone investing over a decade, stocks provide the necessary growth. Bonds might return 4 or 5%, insufficient for reaching aggressive retirement goals in 10 years. Success requires equity exposure. Which stocks should someone buy? Buffett distinguishes between sophisticated investors who can analyze businesses and read financial statements versus typical investors who lack that expertise. Sophisticated investors can select individual companies, finding great businesses at reasonable prices and building concentrated portfolios of 10 to 15 holdings. That's Buffett's personal approach, refined over decades. Most people can't do this effectively. They lack the time, knowledge, or temperament. For them, index funds solve the problem perfectly. An S&P 500 index fund owns the 500 largest American companies. One purchase provides exposure to Apple, Microsoft, Google, Coca-Cola, Johnson & Johnson, and hundreds of other businesses, all for minimal cost. The S&P 500 has historically returned about 10% annually, with significant year-to-year variation but consistent long-term performance. Buffett's recommendation for typical investors involves simplicity itself. Open a retirement account, either an IRA or 401k. Every month, invest a predetermined amount in a low-cost S&P 500 index fund. Make it automatic, mechanical, emotionless. 3,000 monthly, 5,000 monthly, whatever the calculations indicated was necessary. Continue this process for 10 years regardless of market conditions. This strategy has a name: dollar-cost averaging. Its power lies in mathematical certainty. Investing the same amount monthly means buying more shares when prices fall and fewer when prices rise. Over time, this produces a favorable average purchase price without requiring market timing skills. Someone following this approach doesn't need to predict bull and bear markets. They simply buy consistently month after month, accumulating shares steadily. Taxes profoundly impact investment returns, something Buffett factors into every calculation. Money invested in taxable accounts generates tax bills on dividends and capital gains annually. These taxes reduce returns and slow compound growth. Money invested in retirement accounts like 401ks and IRAs grows tax-deferred until withdrawal. This tax treatment creates enormous advantages over decades. The difference shows clearly in comparative examples. Investing $5,000 monthly for 10 years at 10% returns produces roughly $900,000 in a taxable account after annual taxes. The same investment in a tax-deferred retirement account produces over $1 million. That $100,000 difference comes purely from tax deferral, illustrating why Buffett emphasizes maximizing retirement account contributions. The optimal sequence starts with 401k contributions, especially if employers provide matching funds. Employer matches represent free money, the best possible return. After maximizing 401k benefits, fund an IRA. Then consider a Roth IRA if income qualifications allow. Getting as much money as possible into tax-advantaged accounts maximizes growth potential. Market crashes concern every investor, and Buffett addresses this fear directly. Markets crash regularly, roughly every 7 to 10 years. Major crashes occurred in 2000, 2008, and 2020. Another crash will almost certainly happen within any 10-year planning window. Someone pursuing aggressive retirement goals will likely experience a significant market downturn. The question isn't whether it will happen, but how to respond. Most people view crashes as catastrophes. They panic, sell holdings, and lock in losses. Buffett considers this exactly wrong, the worst possible response. For someone still accumulating wealth, still saving and investing monthly, a crash represents opportunity. When markets drop 40%, everything goes on sale. Expensive stocks become cheap, and monthly investments buy more shares for the same dollar amount. When markets recover, and they always eventually recover, those shares purchased cheaply produce substantial gains. Buffett encourages embracing crashes during accumulation phases. As long as someone continues working and saving, market downturns are friends, not enemies. They create buying opportunities. The exception applies to people retiring soon, within a year or two. For them, crashes create genuine problems because they're about to start withdrawals. Taking money from a depleted portfolio can prove dangerous. As retirement approaches, Buffett recommends gradually shifting some assets from stocks to bonds. Not everything, but perhaps 20 to 30%. Bonds provide stability, cushioning against stock market crashes. If markets collapse right at retirement, someone can live off bonds for a year or two while waiting for stock recovery. This tactical allocation manages risk without abandoning equities entirely. Healthcare costs represent a critical consideration that many early retirement planners overlook. Medicare begins at 65, but someone retiring at 55, 50, or 45 faces a coverage gap. Private health insurance for a couple can cost $1,000 to $2,000 monthly, meaning $12,000 to $24,000 annually just for healthcare. This massive expense must factor into retirement spending calculations. Someone who planned on $50,000 in annual expenses might discover they need an additional $20,000 for healthcare, pushing total needs to $70,000. That requires a larger portfolio, $1.75 million instead of $1.25 million. The difference is substantial, and many people encounter this reality only after leaving their jobs. Buffett emphasizes planning for healthcare costs upfront to avoid unpleasant surprises. Early retirement isn't simply about covering living expenses. It requires funding healthcare, taxes, insurance, emergencies, and unexpected costs. Building a margin of safety into every projection protects against the inevitable problems life presents. Cars break down, roofs leak, people get sick. Someone who plans everything perfectly with zero buffer will eventually face trouble. Conservative planning, saving more than necessary and spending less than possible, creates the resilience needed for successful early retirement. Buffett recalls a friend who retired at 55 approximately 10 years ago. This individual did everything correctly, saving aggressively and investing in index funds, building $1 million portfolio. His calculations showed he needed $40,000 annually, and 4% of 1 million equals $40,000. Everything looked perfect initially. Markets rose, his portfolio grew despite withdrawals, and he lived his dream life, traveling and spending time with grandchildren. Then 2022 arrived. Markets dropped 25%, shrinking his $1 million portfolio to $750,000. He continued withdrawing $40,000 annually, but now that represented over 5% of his portfolio instead of 4%. At that withdrawal rate, he'd deplete his savings. So he returned to work part-time, doing consulting not by choice but by necessity. His plan lacked sufficient margin of safety. This isn't a tragedy. He's still better positioned than if he'd never pursued financial independence. The part-time work provides structure and purpose. But more conservative planning, saving slightly more or waiting a few extra years, would have provided true freedom. He wouldn't have needed to return to work. That's why safety margins matter so much in Buffett's approach to financial planning. For someone serious about retiring in 10 years, Buffett offers clear recommendations. First, determine actual spending by tracking every dollar for several months. Not theoretical spending or aspirational spending, but real current spending. Multiply that annual figure by 25 to get the retirement target using the 4% rule. Someone spending $50,000 annually needs $1.25 million. Next, calculate how much existing savings will grow over 10 years using conservative return assumptions, perhaps 7 or 8%. Determine the gap between projected savings growth and the retirement target. Divide that gap by 120, the number of months in 10 years. That's the required monthly savings amount. If that monthly savings number proves impossible to achieve, 3 options exist. Work longer than 10 years, allowing more time for accumulation. Spend less in retirement, reducing the required portfolio size. Earn more currently, creating capacity for larger savings. Those are the only options. Pick one and commit to it. Buffett frames retirement planning as mathematics, not magic. Simple, honest mathematics. Many people resist doing honest math. They want to believe they can retire on less than they actually need. They assume markets will always rise, emergencies will never happen, and healthcare will cost little. That's wishful thinking, not planning. Real planning assumes imperfection. It builds in buffers and safety margins. Honest, conservative planning enables successful early retirement. Excessive optimism leads to disappointment. The psychology of retirement matters as much as the finances. Having sufficient money represents only half the challenge. The other half involves knowing what to retire to. Many people view retirement simply as not working, but that's insufficient. People need purpose, activities, structure for their days. Buffett has seen wealthy retirees become miserable because they're bored and feel useless. Before retiring, carefully consider how to spend time. Hobbies, volunteer work, enjoyable part-time work, travel, learning. Something meaningful must fill the days, or retirement becomes empty. That's one reason Buffett has never retired. He loves investing, running Berkshire Hathaway, working with people he respects. Why stop? Money doesn't motivate his work. He has more money than he could possibly spend. Work provides his life meaning and purpose. Many people would find greater happiness by reframing their thinking. Instead of asking how fast they can retire, they might ask how to find work they love, work they'd want to do even without needing the money. When someone loves their work, retirement becomes less urgent. Financial independence remains valuable, providing the ability to quit if circumstances change. But there's no desperate counting of days, no frantic escape planning. Just living, doing enjoyable work, building wealth as a natural byproduct. The core question remains: how much should someone invest monthly to retire in 10 years? The answer depends on current savings, required spending, and expected returns. As a rough guide, someone starting from zero who wants $50,000 annually probably needs to invest $5,000 to $7,000 monthly. That's $60,000 to $84,000 yearly, beyond most people's reach unless they earn high incomes and live extremely frugally. Someone with $100,000 or $200,000 already saved faces easier numbers, perhaps needing $3,000 to $4,000 monthly. Someone willing to spend less in retirement, living on $30,000 or $40,000 instead of $50,000, needs even less, maybe $2,000 to $3,000 monthly. The key element is flexibility. Rigid thinking creates failure. Someone who insists they must retire in exactly 10 years and must spend exactly a specific amount sets themselves up for disappointment. Life doesn't work that way. Flexible thinking creates success. Someone who'd like to retire in 10 years but will adjust based on reality has much better odds. They can adapt and respond to circumstances. Maybe markets perform exceptionally well and they retire in 9 years. Maybe markets crash and they wait until year 12. Either way, they're fine because they're flexible. For young people in their 30s or 40s considering early retirement, Buffett's advice is simple. Start immediately. Begin saving today. Start investing now. Even if the math doesn't currently support retiring in 10 years, every dollar saved today compounds and grows, creating options later. More importantly, the habit of living below means and investing regularly proves more valuable than any particular investment return. Building that habit and making it automatic leads to financial independence eventually. Maybe not in 10 years, maybe in 15 or 20, but it will happen. And when it does, freedom arrives. Financial independence isn't really about retirement. It's about options, about not being forced into unwanted situations. Maybe that independence enables full retirement. Maybe it enables career changes, business startups, part-time work, or extended travel. The point is having choices, not being trapped by the need for a paycheck. That's freedom, and that's what Buffett believes people are truly seeking. Buffett achieved financial independence in his 30s, possibly earlier. Not through overnight fortune but through consistent habits developed early and maintained throughout his life. He lived below his means, invested the difference, and let compound interest work its magic over decades. He never tried to time markets perfectly or find secret investment strategies. He simply bought quality businesses at reasonable prices and held them for years, letting the businesses grow and compound. That approach, boring and unglamorous as it sounds, built one of history's great fortunes. It can work for anyone willing to embrace its principles. Start early, save consistently, invest in quality assets, keep expenses low, and maintain patience. Over 10, 20, or 30 years, these simple habits create wealth and eventually freedom. That's Warren Buffett's real secret, and it's available to anyone disciplined enough to follow it.